Probability of significant market moves. Okay, we're going to take a look at what are the chances of a big outlier move in the S&Ps, and then what are the chances of a second move after the first move. Okay, so like any kind of continuation, things like that. Let's take a look. Really good study. So the historical average daily movement of the S&P 500 has been plus or minus 0.5% in either direction. Just to put that into context, okay, in the S&Ps right now, they're just under 5,000. So 0.5% would be about a 25 handle move in the S&Ps, all right? Mm-hmm. It's about, and that's essentially close to where we're pricing things in right now at these levels. And so it's pretty.
That's correct.
Yeah,
that's correct.
However, in the past month, we've observed a decrease with 0.44 and 0.34, much lower than the long-term average. A lot of people have been writing to us and saying, I've been killing it on the 0DT spreads. Mm-hmm. Mm-hmm. Do you want to know why you've been killing it? Because that 0.44 and that 0.34 are way lower than that 0.5. And that's why the 0DT strangles and straddles have been killing it.
Right, and that's a double-edged sword, right? That's good.
Yeah.
And you got to worry for, when it gets back to normal, right?
Yeah, right. But people always write to me, they go, I can't believe these strategies work so well. I can't believe your research is so great. And I'm like, listen, our research is good, but you need the market to cooperate. You need the market to accommodate. And the reason that those strategies have worked is because we're about 35% under our average daily moves over the last, 2 decades. And so when you take that into perspective, higher levels, lower moves, everything on the zeros has been working. It won't stay like that forever, I promise you.
Of course.
Let's go to the next slide.
That being said, we won't miss our opportunity to put that trade on today, maybe.
No, you got to keep doing it until it doesn't work. As concerns about the potential risk on the downside continue to grow because we're at record highs, we're interested in understanding the probability of a significant market move in the long run. Let's take a look. So we've analyzed the probability of the SPX having a 1%, 2%, 3%, and 5% daily changes within a 5-day trading period over the last 20 years. All right. Now, a 1% move, just to put a context around it, is a 50 handle move in the S&Ps. 2% is 100, 3% is 150, 5% is 250. There's very few 5% moves. Mm-hmm. Let's go to the next slide. So the probability of experiencing large daily moves such as 3 to 5% in a week so far has been 0 this year. But the probability of having a 1% or having 1% or greater move in a week is fairly high. So, and again, plus or minus 1% move, you're talking really about 26% chance on day, and then correspondingly on the following days, you can see how the number drops off dramatically. And a 2% move, and then obviously a 5% move, we haven't had anything like that this year. And on a 3% move, really nothing like that, and no follow through in like consecutive days. Like, well, what they're saying here is if you have a 2% move, there's a 7% chance of a 2% move today, and then a following day, there's less than a 1% chance. And 5 days later, there's less than a 0.1% chance. So that's all these numbers mean. So you're basically, based on recent performance, if we look how we're, where the market risk is, there is risk in the 1 days, but there hasn't been a lot of follow-up risk except for a 1% move. So there's 26.
Going back to that, earnings trade of why you look for the back month instead of the front month. These are good numbers to look at too. You'll see that there's a lot less risk when you go out 45 days, even just the time frame, plus the expected move of each product.
Yeah, and when you look at these numbers, you start to think, okay, because what are the chances you're going to see, 3 consecutive up days or down days of 1%, and it does start to drop off, but there's significantly higher chance of 3 consecutive or 4 consecutive down days of 1% than there are of 2, 3, or 4% or 5%. Mm-hmm. Let's go next slide. So we also know that extreme market movements can last longer than expected, like we're experiencing now. So we're curious if these large moves are independent from one another or not. Now we're going to argue, yeah, sure, of course they're independent, but let's see. Next slide, please, John. So we found that moves plus or minus 1% or smaller tend to be largely independent. However, this was not the case for greater moves. So if something really ugly happens, there's a better chance of something uglier happening afterwards. If something just inside of a 1% range happens, there's almost no correlation to it happening the next day. All right, does that make sense?
Yes.
So the chance, I'm looking at the middle column, chance occurring directly after such, directly after a move of such magnitude is extremely high compared to the chance of it occurring on any day. So when you have moves of, let's say, 5% or greater, it's 40 times more likely to see another great move. When you have moves of, like, basically saying if something really ugly was to happen in the market, there's a 40% chance, 40 times chance that the next day it's going to be, or the next couple of days, you're going to see another big move. When you see moves of 0.1 to 0.5%, so like that means like a $10 move or 10 handle move to a 25 handle move in the S&Ps, there's no difference from day to day. And then when you see 0.5% to 1%, there's no difference from day to day. But when you start getting in the 2 to 5% moves, which is like 100 to 200 and 250 handles in the S&Ps, there's a 3.5 times greater chance you're going to see another big move the next day. So what it's basically saying is just be a little bit aware. If there's a big move, there's chances are there's going to be another big move behind it. But those are big moves over, you know, a 50 or 60 handle. Yeah, you're going to need a very big opening day move to basically support, you know, follow-up moves like that. Next slide, please. This suggests that outside moves often occur in clusters during certain time periods. It's exactly right. For instance, for a 5% increase or decrease over 2 consecutive days, the likelihood of it happening is 40 times higher than if the events were independent, which is 1% or less. Just means on a normal market day, you're not taking anything out of that day. It doesn't mean anything. On a day where there's a huge outside move, there is a much greater chance of having another huge outside move or outlier move. Let's go to the last slide. There is a low takeaways. There's a low probability of consecutive significant market moves, such as those exceeding 3%. Smaller daily market movements, usually less than 1%, tend to be more independent. However, there is a significantly higher chance of larger movements of over 2% happening immediately following the first event. So if you have a big move, look for another big move. If you don't have a big move, it's going to be pretty independent what happens the next day.
Very good. Any surprises in there for you?
No.
Let's take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell sound off.